Hope everybody's having a great day. Comment if everything looks right to you. I haven't done one of these lives on my main channel in a while, so I want to go over Whirlpool stock today. Somebody requested it in the Discord. This is a little bit impromptu, just before work. Right. Let me figure out how to get this picture in picture. Let's see here. Yeah, not really sure how to get my screen to share the way I want it to. Let's see here. So somebody was mentioning that they thought Whirlpool stock was a value. Personally, I'm not sure about that, but definitely interested in seeing if that checks out. So I will say, looks like Whirlpool has had declining revenue for a hot minute. And let's see here. All right, there we go. So, all right. We've had a bit of declining revenue for a hot minute on this. Now, granted, it's not like tremendous sharp revenue decline, but not necessarily what you want to see. Let's see, in the financial ratios, the PE is negative, which makes me think that they don't have net income right now. All right, that's a little bit concerning. Price to sales, it's at a pretty low point for what it usually trades at. All right, it does look like they have positive free cash flow, but they're trading at over 33 times. Okay, not necessarily the type of stuff I expect in a value stock. Let's see here. Now, they have bought back a lot of shares over the last decade, so that's good. You want to see share count declining. Let's see how the net. Okay, so this is on a trailing 12-month basis each quarter. Yeah, the last 4 quarters, it's just been a disgustingly negative net income situation. We look at it on the quarterly basis. Okay, they're just now back into barely positive net income. So it looks like they had 3 quarters here that were negative, and these 3 very slightly positive. Not beautiful. Not beautiful. Free cash flow is all over the place. Look at that. Look at that free cash flow. That's exactly what you want to see. It's like each year they alternate being negative or positive. Now, to be fair, it does look like the positive free cash flow outweighs the negative, but again, like, do you want a company that's got negative free cash flow every other year? I don't know. They do pay a dividend. Okay. They do pay a dividend. $7 per year, according to this. They haven't grown it lately. Yields 6.22%. Okay, that's not bad. You pair that with the buybacks. Maybe it's good if they're buying back at cheap prices. So not too bad, not too bad. And they at least haven't cut the dividend recently. At least in the last 10 years. It's only gone up, never down, but it's definitely pretty flat lately. Huh. I wonder what the analysts think of this. So we've got, let's see, a high of 160, average 134, low 92, current price 112. That's curious. Yeah, hold rating, pretty boring. Now for earnings. Hmm. All right. Well, it looks like what we have here is them anticipating when the final numbers come in for 2023, $15.95 earnings per share, barely increasing the next couple years to 16 and then 16.64. So I guess the question is, at these prices, is it worth it for that much earnings with like basically no growth? And let's be really honest, I don't think they're going to stop having occasional quarters of negative free cash flow, because it was like every other quarter negative free cash flow. And maybe that's just like the sales cycle of Whirlpool. Well, like they sell a bunch of jacuzzis or whatever, and then they might recognize that as net income or whatever, but then the cash doesn't come in until later, and that's why every other quarter it seems like they have negative free cash flow, because they're always chasing the cash from the stuff they like sold and had to like produce the previous quarter. Something like that, if I had to speculate. It's just, at the same time, like it's a little hard for me to get excited about Whirlpool. Let's see here. All right. Yeah, like a lot of value stocks, if you just roll with the standard that's in the DCF, it comes out just looking peachy. What was the? It was just under $16, they were saying, so we'll just say that. Tangible book value negative $79 a share. All right, cool. Um, to be honest with you, I mean, are they even going to grow really? That's the thing. I mean, you drop this to like inflation type numbers, or what they target for inflation type numbers. And even if you leave in the 10% discount rate, I mean, yes, you could just say, well, I don't care about their balance sheet and it comes out okay, but negative 79 intangible book value on a company like Whirlpool, like, is that a lot of debt that they have there? That's what I'm curious about. What is their debt? All right, so total debt $8.2 billion. Now, they technically have positive book value, but yeah, we've got a lot of goodwill here on the balance sheet, and that's an issue with good, that it kind of comes and it goes. So in the past, they've made some kind of an acquisition, bought the target for more than the assets that it had on its balance sheet, which is normal, but the remainder is accounted for in the goodwill line. And if that acquisition ends up being crappy, like gosh, what was it? AT&T had Dish. They bought the Dish network at one point, and it was like billions of dollars that they paid, and they ended up having to write off most of it. So Yeah, that's one reason why goodwill isn't considered as part of the tangible book value. It's just it's like funny money unless what they bought has like a really, really strong brand or something like that, and they could sell it off for again more than what its assets are in whatever division that is that they're selling. Yeah, long-term debt, almost 7 billion. Yeah. Mm. Gosh, what was their market cap again? Oh, their market cap is 6.18 billion. Yeah. So yeah, they've got a pretty hefty debt loading. I mean, it's not like insane debt, but it seems like yeah, it seems like the balance sheet is like eh. I mean, if you're not worried about that debt at all and whatever. I mean, the thing is, if unless their cash flows are really consistent, I don't know if I like excluding the debt. So, I mean, I think punish them. And then it's like, okay, well, maybe if they fall to, you know, $90 or $80, it's worth a look. But then this is still using a 10% discount rate. I mean, are we value investors or are we not value investors? 12.5%. Okay. So what is it? If it falls below 70, 65, it might be worth a look. Is that what we're saying? I mean, maybe I'm just being too cheap, but it's really hard um, to even really use DCF with, again, how unpredictable their earnings and cash flows seem to be all over the place. Oh, okay. eBay. All right. Well, while I'm here, I've still got another like 10 or 15 minutes before I need to go to work. So we'll take a quick look at eBay. I haven't really looked at eBay that much lately. So um, obviously, back in the day, I remember when they still had PayPal as a division. That was interesting. So what we have here, all right, we've got a $21 billion market cap. All right. Yeah, kind of flat to down over the last year. Yeah, kind of hasn't really gone much of anywhere in 5 years. That's kind of funny. But let's take a look here. Mm, revenue's like sort of flat, but if it's cheap, I don't really like if it was trading for like 3 times earnings, who cares if revenue's flat, right? Okay. Oh, okay. That's a little bit all over the place. Free cash flow is a little bit more stable. Good gross margins. They're pretty steady, but a little bit lower than what they used to be. Looks like a growing dividend. Oh, and of course, yeah, you were talking about these, but whoa, okay. All right, all right. I see where you're coming from on this. So yeah, that's a lot of buybacks. So let's see, $40 a share. Free cash flow per share is so they're like less than 10x their recent free cash flow. So that's pretty cheap. Yeah, that's yeah. I see them. I see them. Holy moly. Um, let's see. Oh, you know what? I think I've got the my screen's still on Whirlpool. That's weird. Let me see here. Yeah, so I'm like a complete noob with this whole studio deal. Let's see here. Um, hmm. All right. That should now have eBay up. So these are the buybacks we were talking about. Your DCF with 20% margin around 43. What discount rate were you using? If you don't mind sharing that with the class. And again, hey, like I think eBay is far from a dying business. It's just not in its, extreme growth stage anymore. Like I don't think eBay is going away. So, but yeah, I mean, the net income is a little bit inconsistent, we'll say. Um, EPS inconsistent, but again, free cash flow again not like a super consistent or even like trending in one direction in specific, but I'd say the free cash flow looks a lot more stable than the net income or earnings. 11%. Okay, I mean that's pretty conservative. That's a pretty conservative discount rate. Um, let's see here. Gosh, kind of. Let's see here. There we go. I mean, all right. So regarding the Whirlpool stuff, yeah, like if you put in a higher discount rate, really low growth, and all that, and it really depends on how you factor in the balance sheet. You know, the negative tangible book value is rough on that one. But no, let's take a look at eBay. So, interesting. Thing I'm wondering about eBay is what kind of growth to put in. So, let's see. Looks like analysts put it in low to mid single digits for EPS growth. So, I think I think I can get behind that. Um, what do you want to call it? 5% dropping to like 3%, something like that seemed pretty reasonable for an eBay. I mean, with the buybacks and everything under consideration, yeah, I think it's probably pretty reasonable. And I mean, you said an 11% discount rate. I mean, okay. I mean, I prefer 12 and a half if I'm going for value. I mean, with my assumptions, I'm getting, pretty similar price to you either way. So I guess, it depends on how you skin the cat, right? Um, yeah, I mean, honestly, 429. They're talking about 429 for 2023. I mean, am I doing too much growth? Huh. Oh, so I'm gonna guess you probably didn't add on their tangible book value on top, and you just ran the cash flow numbers, but didn't factor in the balance sheet at all. Because if I, let's see, if I just did 4% infinitely, don't factor in the balance sheet, do 12 and a half, I get a slightly lower price than you. Yeah. And that makes sense because you did 11, I did 12 and a half. But yeah, so I think you and I are probably following about the same logic on this. eBay could, yeah, it could have potential. I mean, here's the thing. If they average just, $4 and change free cash flow, I mean, you're getting like a 10% return, or maybe just more, just above a 10% return just on the buybacks, right? So, for a stable business, if they trade at a low multiple and the company has a lot of cash, they can just throw out buybacks. Yeah, you can make a um like a good low double digit return, like 10, 11, 12% pretty easily. And, I think with minimal volatility. Yeah, that's the thing. Like, yeah, I mean, it's not that hard to necessarily make one in Excel, especially if you are in a line of work where you're using Excel a lot for your day-to-day job. So yeah, HPQ is definitely it has a beloved place within my portfolio as well, but um yeah, the buybacks especially kind of, remind me of it. But yeah, personally though, like there's a ton of free DCF calculators on the web, and this one, I think it visually looks a little bit nicer for like, live streaming and the channel and videos and stuff, a little bit more than just an Excel sheet does. And presentation means a lot. And plus, it's free. And I know on the back end, like behind this web page and this, fancy little display with like the overvalued, undervalued arrow and stuff, it's just running in what is essentially an Excel sheet behind there anyway. Because I'm just putting in the fields and it's putting them into the inputs, and it's just displaying the output on this web page. And I think as long as you have an idea of like how it actually functions behind yeah, hey, you're welcome. I appreciate you joining this random live that I didn't even announce on Discord, and I just kind of went live. Um I don't know. I was just feeling it. I wasn't really feeling like doing much editing, but I was feeling like just randomly talking about some stocks today. And I kind of prefer actually interacting with people during these conversations. I I like when I do solo videos, like it just feels weird talking to myself, if that makes sense. So yeah, I kind of prefer this from like a me having fun on the channel kind of perspective. So yeah, definitely appreciate you hopping on and suggesting a couple stocks to look at. Honestly, like I do think I want to take a closer look at eBay. The actual original request here again was Whirlpool, and my big issue there is basically that every other quarter they basically had negative free cash flow. They don't. They have a lot of goodwill on their balance sheet, which you know doesn't necessarily count for a whole lot, and they do have debt that's like pretty close to their market cap. So like their enterprise value would be like double their market cap essentially. And these growth numbers, I just do not buy. Like this is basically just assuming the next 10 years mirrors the last 10. And when you put in something that's more realistic, like Whirlpool is probably past its fast growth stage. And so like I don't know. I can't quite get there on Whirlpool necessarily being a value play. Yeah. So I already, and this is a great point that you just made. I already believe that wholeheartedly because I used to be really into like rental properties. Like, have you ever heard of the website Bigger Pockets? It's all about rental properties and apartment buildings and all that kind of stuff. So if you're buying, a rental home or like an apartment building or something, your valuation of it is purely based on the future cash flows it will provide you. Plain and simple. And I really, prior to a few years ago, I didn't really realize the connection where you could think of stocks the same way. And that really has made it feel a lot easier on like an emotional level, because if you don't really understand what really makes stocks move the way they do over the long term, it can be really easy to, freak out, not understand why something's dropping and, sell, or not understand why something is up a lot, think it's going to just keep going up, not really pay attention to valuation and just buy based on enthusiasm. I think you see a lot of that with stocks like Nvidia and AMD and um, Tesla, all those. So there is definitely something to be said for basically your investments, that you should view them as a stream of cash flow, and that's how you should determine what you're willing to pay for them. You look at it and say, this is something that will pay me. And in this case of in the case of eBay there, right? Um, it'll pay about, $4 to $4.50 in terms of free cash flow. That's what it can generate. And do I think it's worth paying $40 for $4 to $4.50 worth of free cash flow every year? And if they return most of that to you in the form of dividends and buybacks, it really is just that simple. Now, it's more complicated if they're reinvesting for growth, because then you need to try to factor in what you think the growth will be into your model. But if you don't think that there's really going to be much growth, or you only think the growth is going to be about, the EPS should theoretically grow if it's stable revenue, stable margins at about the same rate that they buy back shares, because that drives up EPS. But yeah, and there is some like question of whether the growth in EPS that comes from share buybacks is sort of double dipping on counting that free cash flow towards your valuation, if that makes sense. Because it's like that isn't cash that's necessarily like the cash that it's spitting out isn't necessarily growing on an overall basis, but the per share amount's going up just because they're buying back the shares and deleting them, basically. But that being said, I like buybacks because, you know, it basically drives up my ownership stake for free. But I don't really necessarily like it when a company that trades at a huge premium does a lot of buybacks, because it's like, bruh, like you would have to think, like at a certain point, if I'm sorry, but if you're trading at like a 30 times multiple, like I would rather you probably focus on growing the dividend at that point more so than the buybacks, because it's, man, like overpaying just to keep your stock price inflated. I don't know. I think that's a waste of shareholder money, to be honest with you. But yeah, eBay's buybacks though, because again, they're at like what, like a we were saying like a 9 or 10 times their free cash flow. I mean, that's pretty good. All right, now all of a sudden it only wants to give me stuff in euros. That's weird. So, yeah. I think let's see, we're just about at the 30-minute mark, and I gotta hit the road and be to work in like 10 minutes. But thank you for the suggestions of stocks to look at. I had a good time with it. And anybody that's just catching it right now, as soon as I'm done, YouTube will have to do some processing, but look back for the replay and just watch the replay. I screwed up with the screen sharing a few times because, I haven't done a live on a while, and I'm a little bit. Oh yeah, The That's MPW. Let me say MPW a few times so that the algorithm can pick that up and push the video after this ends and it processes. So, yeah, let me know let me know how the steward stuff ends up with them. Oh, appreciate that, Brett. Yeah. Yeah, for expensive stocks, yeah, I think dividends over buybacks when the share price is high, you know? I think and then I think if stocks experience a drop in share price and it becomes undervalued, I think the board should approve buybacks instead of like maybe don't eliminate the dividend, but maybe like that year instead of doing a dividend increase, put the extra money towards buybacks. Like the only problem is a lot of these companies that become like, dividend aristocrats or whatever, they don't want to give up that title. And so I think they persist with the dividend even when the stock is cheap and they might be better off. Like they might give more shareholder value with buybacks, but on the opposite end, shares of stock of companies that are expensive, it feels like a lot of times they prioritize the buybacks just to keep the share price high, just because when they would again probably provide more shareholder value just in bumping up the dividend while if they don't have a way to spend the money to grow or pay off debt or something like that. And acquisitions are another thing. Like I think a lot of companies do overpay a little bit. They get a little acquisition happy, and um that's definitely kind of an issue. Like I talked about AT&T earlier here, and talked about how they spent a bunch of money on Dish Network, and it ended up in billions of dollars of write-offs later. And that's also why the goodwill on the balance sheet of a company like Whirlpool, question I kind of penalize them for tangible book because goodwill is not counted on the tangible book, and that makes the balance sheet look worse. But what brands do they really have that they could sell at a premium? And I mean, Altria had Jewel, or they had like 35% of Jewel, which they overpaid through the nose for and had to do a big write off there. So now they made their financials look wonky for a minute after they did that write off. And Altria is another one where, I know they're in the tobacco industry and there's some declining happening there, but if they're cheap compared to how much cash they produce, I really wish they could like, and then, fellow Altria investors would probably want to lynch me for saying this, but I think they could stop bumping the dividend for a while and put that extra money into buybacks. I really think that would actually serve shareholder value. That would provide more return and more shareholder value for Altria shareholders right now than more dividend bumps. I mean, you can debate me on that all you want, either on Discord or in the comments after this video processes or whatever, but I got to get going off of here, everybody. Thanks for showing up. Appreciate you. Cheers.